Welcome to the course. Today we're going to give you some of the things that you need to know in order to get started. And first off, we're going to talk a little bit about some of the basics of trading. The types of orders, we'll look at a couple of the most commonly used ones that you'll need to know right away in order to participate in the stock market simulation. We'll talk a little bit about how orders are executed. It's very important for you throughout the course to keep records of what you're doing. We'll talk more about that when we talk about the course outline and some of the steps and some of the points of assessment during the course. It's also important that you start thinking about how performance is measured and recorded during the course so that you can complete the final assignment. First off, we'll talk about some of the order forms that you need to complete in order to buy stocks and sell stocks using StockTrak. There are separate videos that talk about the specific type of orders that are included as part of the StockTrak assignment, and we'll talk about that later during our class. But a couple of things just to think about before you even get started. The most common type of order is a market order. In a market order, the order is placed for immediate execution during normal trading hours. The order is received by the broker and executed at the best available price. That price is the one that the opposite side, the seller or the counterparty, is willing to sell for, and the highest price that you as the counterparty are willing to pay. Essentially, we're going to put in an order and the other side accepts or declines the order at that particular price. If the order is received after trading hours or if the order continues after that particular session, it will be kept in the order book and filled at the next best available price. The purpose of a market order is to ensure that you get the best possible or the fastest possible execution, although you really don't know what price you're going to get because the market moves continually between the time the order is placed and the order is executed. There can be an awful lot of movement. If you're using the StockTrak trading platform, and if you click on the trading icon at the top or the trading tab and scroll down to stocks/ETFs, you'll see that you get a screen that looks something like this. I've already partly completed this one. My first decision was whether to buy, sell short, or sell to cover. Rather buy to cover the stocks, and so I clicked buy. That was the first decision. Then under symbol, I chose Amazon. The 4-digit NASDAQ ticker symbol for Amazon is AMZN. So as I start to type in AMZ, it completes the rest of that and asks me if I want Amazon or a couple of other types of Amazon related stocks. Well, I wanted the basic Amazon stock, so I completed that one. And I said I wanted 10 shares at the current price. The current price today, and I am talking to you during trading hours, was $2,331.50, or at least that was the last price that was quoted. You can see down below that the price for somebody who is buying would be, somebody who's selling would be 2331.26. For somebody who's buying, 2332.44. So the asking price by somebody who's selling is the higher price than the price who somebody who would be willing to buy your stock. The range today has been between 23.26 and 23.51. So that's the current trading range during today. And today there have been a lot of shares sold, 1,631,000 shares. So this gives me an idea of some of the important features of the market. It tells me how volatile the stock is, the range that it's trading during the day. The size of the spread between the bid and the ask price tells me how efficient the price is, because there's a little bit in the middle that goes to the market. And the volume tells me that this is a stock that trades quite regularly. So I'd feel pretty comfortable buying 10 or 100 or 1,000 shares at the current market price, that this is going to get filled before the end of trading in a few hours' time. My choice in this case is market. And so as soon as I click preview and then I click confirm order, my trade is almost certain to go through at the market price. And the market price is going to be fairly close to what I see on my screen as the last price. An alternative to this would be to use a limit order. And a limit order essentially says that my broker should only accept prices that are higher than a particular limit. I have to give it a time limit as well, so I'll tell it that I want the order to be good through the rest of the day, until tomorrow afternoon, until Friday, but I have to specify a time limit as well. I'm concerned that I don't want to overpay for the stock. So if I put in a market order and it's 23.31 right now, and perhaps in the next minute or the next 30 seconds there's a lot of activity, the price could go higher. Well, definitely I don't want to pay more than 23.31, so that could be my limit. Also, I could expect that during the day the trading could, because it is so volatile, could go down below 2300, could go down to 2200. I could put a limit order that is below the current market price and hope that the order is going to fill at a much lower price. To give you an idea of how this is working, a couple of years ago, Amazon was trading at about $985. I thought, clearly there's going to be some friction around $1,000 share price, so maybe the price is going to drop before it goes back up. I put in a limit order for $970. The price went up all day and it closed above $1,000. My order didn't fill because it never dropped low enough to complete the order. The next day I thought, well, that was stupid. I should have bought the shares at the market price. So I put in another limit order for $10,020, thinking maybe the price will drop back down below the price of $1,050. Well, unfortunately the price went up all day, so by the end of the day the price never dropped low enough for my limit order to execute, and the price closed below $1,100 the next day. I tried on a third day, the price went up again, and to make a very long and sad story short, I never actually did buy those Amazon shares. Now the price is $23.31 and I wish I had. So a market order gives you the certainty or near certainty of completion. A limit order, there's always going to be some uncertainty. You can see on the StockTrak trading form, here we've made it a little bit more complicated. We still clicked on buy, we still clicked on Amazon, we still asked for 10 shares. The difference here is under order type, clicked on the down arrow. Instead of choosing market, I chose a limit order. And I said my limit stop price was set at 2300. It's currently trading at 23.31, but the range during the day has been 23.26 to 23.50. So I'm hoping that the price is going to fall below 2300 at some point during the day. I'll get a bargain. I'll buy it $30 cheaper per share than the current trading price. Again, perhaps the price is going to go up for the rest of the day and I won't see that bargain again at any point during the trading day. And my order might be incomplete. So there's uncertainty that remains with this particular approach. Those are the two most common types of orders. Now, there are other orders, and we'll talk about those later in the course, things like the stop or a stop loss order. There's also the selling actions that we can take, like selling short, but we'll come back to those a little bit later in the course. Once my order is received by the stock exchange, it's going to go through a process of intermediation. In the old days, folks like this worked on the trading floor with the guy in the background receiving my order. You can see he's reading it off of an order form, completing the order form. And then he would communicate with people who were trading on the floor, who would use hand gestures and a lot of yelling to complete my order, with the people on the other side of the transactions who were essentially doing the same thing, except in reverse. Taking the order or agreeing the order, the person would be completing the ticket on the other side, and it would be submitted at the end of the day to the market. Now it's all done electronically, so it's generally done electronically, so we don't see that human interaction on the trading floor in the trading pits. Moving again very quickly through this very brief introductory session, one of the things that I'd like you to think of from the very beginning is about how do we measure performance of our transactions, of our portfolio. We'll talk a little bit about some of the basic measures of return. Those include things like a holding period yield. How much did you receive from your investment over the period that you held the stock? In a 7-week course, your holding period is going to be very short. But still, we want to know how that return stacks up. And we'll also take a look at the holding period yield on an annual basis. We'll talk about some of the measures that essentially create a charge for risk against that return. Beta is one that you're already familiar with, a measure of the idiosyncratic risk. Alpha is a measure of the return in excess of a normal rate of return. The thing that all portfolio managers strive for is to create alpha. We'll also introduce an idea called the Sharpe ratio, that is a risk-adjusted measurement of return. The holding period yield is determined by looking at 3 bits of information. The first bit of information is the cash flow that we receive from our investment, either dividends or interest that we receive during the period that we held onto the investment. We also have the capital gain, and capital gain requires 2 pieces of information. How much did you pay at the beginning of the period? How much did you receive if you sold that investment at the end of the period? So the capital gain is the change in the investment during the period. So, for example, if we had $100 of income and our investment went from $1,000 up to $1,100, we received $100 in income from the dividend. We received a capital gain of $1,100 minus $1,000, or another 100. So the total rate of return that we received was 100 plus 100. 200 was the yield that we got. To standardize that for the size of the investment, we divide it again by our beginning of period investment, and that gives us the holding period yield as a percent. If our investment was 200, our return was 200, we divide it by the 1,000 in our total investment. That gives us a 20% rate of return. Now, how long did we hold on to the stock? How long did we hold that investment? Was it 1 week, 7 weeks, 12 weeks, 2 years? We can determine what the annualized version of that is by using the formula down below. And you'll see that the heart of this particular equation, we have exactly the holding period yield that we just introduced. We add 1 to that number to turn it into a factor, so we can adjust it for time, and t is the value for time. So we take the time root of 1 plus that holding period yield, subtract 1 from that to turn it back into a percent. It sounds complicated. Don't worry, it's really not that bad. In the example we've just discussed, we said we had certain information. Our cash flow, was 100. Our price at the beginning was 1,000. Our price at the end was 1,100. The holding period yield was equal to 100 cash flow plus the change from the end to the beginning over the price at the beginning. So that tells us that there was 200 in cash flow divided by 1,000. So our holding period yield was 20%. 0.2 or 20%. Now, the annualized holding period yield starts off with that information. One plus 100 plus 1,100 minus 1,000 and let's say we held on to our investment for 2 years. Let's make it 3 years. And again, we have to subtract 1 from that at the very end of the process. So if we take 1.2, the third root of 1.2, that gives us a value. Try that again. The third root of 1.2 minus 1, which is equal to 1.0627 minus 1, which is equal to 6.27%. Now, it tells us that the 20% rate of return that we received over 3 years was equal to 6% on an annual basis. If you take 6.27, you multiply it by 3, you get about 19. The difference between that and 20% is the effect of compounding. You receive that 6.27% each year. If you were going to do this looking at a return over half a year, it would be to the half root. Or if we're doing it for 3 months, the 3/12th root, and so on. So that's the calculation that we're going to see throughout the course. We'll come back to that later. We'll discuss how you're going to apply it to your stocks and your stock portfolio. But it's an important thing to think about right now, or start thinking about right now. Now, you might hear the term alpha. We'll talk about that in class as well. But essentially, the term alpha is a measure of the return that a manager receives, a portfolio manager receives, in excess of a fair return. Nobody wants just a fair return to their investment. We want to make better than fair. We want to outperform. If you're looking for somebody to manage your money, you're not going to choose somebody because they're average. You want somebody who has a history that suggests they're above average, and they've been able to produce alpha. It's a common term that we hear in finance. Alpha is the objective of all investment performance. It's based on the idea that risk and return, and the trade-off between risk and return, gives us that fair rate of return relationship that we describe in corporate finance courses as the security market line, the fair trade-off return. And we want to be above the line. We don't want to be below that line. So the line itself describes the relationship between an investment in a risk-free investment and in a company or a portfolio with a beta of 1 or a beta of 1.2 or a beta of 1.3 and so on. So the market beta, the risk premium, describes the slope of the line. The alpha suggests where we sit relative to that line. And of course, there's noise or random error. So your portfolio hopefully is going to generate positive alpha. If you're unsuccessful, your alpha is going to be negative, and it tells us we would have been better off putting our money into a mutual fund that tracks the stock market. The Sharpe ratio is probably the best known measure of portfolio performance. It compares your alpha, the excess returns, against the standard deviation of the portfolio that was used to create those returns. If you have a high standard deviation or a lot of risk, then you're going to discount the alpha by a large number. If you've had a very safe set of investments, then you have a very small denominator, and it makes your alpha look even better. The numerator is essentially that measure of alpha. It's the difference between the portfolio rate of return and a benchmark. Usually the benchmark is the risk-free rate. The denominator is the standard deviation of the portfolio returns. And it suggests that you're going to be skillful or less skillful than the average investor in your group of, or the average manager in the group of competitors. Essentially, it's considered to be a reward to variability ratio. And the calculation of it says that we need to have 3 bits of information. The actual returns to a stock or a portfolio, R sub P. The returns to a risk-free asset, like an investment in a 5-year government bond or a 10-year government bond. And the uncertainty of the variability of the portfolio as measured by the standard deviation of that portfolio. We won't go into the details of calculation, but you can see as computed by a spreadsheet, I'll show you how to do this a bit later in the course, we have an investment that's been held over 12 years. The yearly return to that, the difference between, well, basically the holding period for that holding period return for each of those years is given in the second column for each year. The risk-free rate of return was 0.5% as given by 0.05 of a percent as given by the next column, and it didn't change throughout the period. The excess return, the return from year 1, 0.259 minus 0.05. The excess return, a positive number in the first period, 0.209. So we can take the average return, the average excess return, and that's been calculated at the bottom. Using standard statistical approach, we calculate the standard deviation for that column. It's 0.169. So 0.141 divided by 0.169 gives us a Sharpe ratio of 0.83. It's a positive number, that's not bad, but most importantly, it's hopefully better than our competitors. So the highest Sharpe ratio is the best fund manager. You're going to need to start thinking about calculating this for your portfolio right from the beginning. So in summary, what you buy matters. Which investments you make are going to be important. But smart shopping is also going to be important. Buying at the lowest price. We know from our experience that it is nearly impossible to time the market. But using things like limit orders can also reduce the average price of our purchase. We'll talk about other types of orders and much more detail about order execution as we go through the course, but for now this is a quick taste. You'll also need to start thinking about accounting for performance for your portfolio right from the beginning. I wish you great success with the stock market simulation, and I look forward to talking to you more about this in class.